Yeah. So now we will discuss, some aspects of business valuation, which is closely linked to the whole entrepreneurial journey. Um, uh, so, I think if you look at, I think, I thought that this slide will give you a picture, and of course, I think I'll explain to you some of the concepts in the subsequent this thing. Is that so? How do you determine the intrinsic value of a business or a company? Intrinsic value means essentially based on the business valuation techniques, and which is different than the price. Okay, so this is based on the a discussion. I mean, this is based on the technical evaluation by adopting a business valuation methodology. Okay, you arrive at the expected value of a business or an asset. Okay, whereas the market price is different than the business valuation. I mean, a market price is different than the intrinsic value, because market price is actually is a culmination of the demand and supply negotiation between two parties, etc. But when you are determining what is going to be the price at which I will buy or sell business, or I'll buy or sell asset, one of the base document or one of the base valuations will be the intrinsic value. So how do you arrive at the intrinsic value? So typically your sales minus operating cost and taxes, because tax, why taxes is because tax is also an outgo. I mean, I'm going to pay cash for paying taxes. And less, okay, requisite investment in operating capital will essentially give me what is known as a free cash flow. So what is operating capital? Operating capital is all the my incremental capital investments, incremental investment in my inventory, incremental investment in my current assets, minus current liability. So if you look at the balance sheet, you will say, what is my net working capital? The net working capital is the difference between current assets and current liabilities, is net working capital. Okay. Then what is that other investment which is required for the company to make? Is obviously investment into land, building, plant and machinery, etc., etc., which could be funded by debt, or which could be also funded by the equity. So after taking out, so sales minus operating cost minus taxes, okay, will be what you arrive at is a free cash flow. So free cash flow is nothing but cash which is ultimately going to be available to the equity shareholders. Okay, and how you derive at a value is that, so what is a free cash flow which is generated by the business is compared with what is the required rate of return which an investor is expecting into my company. Okay, so what happens is that, so suppose if my rate of return, or rather the free cash flow which is generated by the company is that rate is equal to or less than the required rate of return which is expected by the investor into similar kind of business as my company's business, then what happens is that the company's value will get eroded because the investor can actually invest in other businesses rather than your own company. So the difference between the two over a perpetual business or the business cycle of the company will essentially give you valuation or intrinsic value of the company is what is the critical principle of a business valuation. And what is the weighted average cost of capital? Weighted average cost of capital is nothing but cost of debt and cost of equity and the combination of the two. Okay, so this is what it is, and how that will be determined is that the lesser the risk, okay, of the business, okay, the lesser the cost of capital. The more the risk of the business, the more cost of capital. So for example, an infrastructure company's cost of capital will be more than the, say, TCS or Infosys, because these companies are all debt-free companies generating year after year revenues, which are dependent on export, etc. So the less risk will be less. Yeah, so business valuation is essential for what? So typically a company will do business valuation when you're buying or selling an asset or a business. So typically M&A transaction, if you're issuing stock option plan, then you will do stock option. Then, various activities actually, stock, convertible loans, restructuring, merger, demerger of businesses, buyer-sell agreement, venture capital, when you are raising funds from venture capital, whereas raising fund from a private equity player. When you go for an IPO, I think, so how the IPO price is determined? The IPO price is determined based on the valuation which is done by the investment bankers and the merchant bankers, okay, and so on and so forth. So if I have a company which has got a very strong, say, technology product, for example, some ERP solution or some product which is there, or software product, then there are ways and means in which you can actually do a valuation of that. So those are the some of the things. And even for the impairment testing, so what happens is that when I have a business and I have, say, in my books, intangible assets or goodwill, etc., etc., the accounting standards actually require the companies to do an impairment testing on an annual basis. So the business valuation is required for that. There are certain valuation myths which are there. Is that when I do a business valuation means I get only one business value? No, it is actually extremely judgmental. Okay, so what happens is that typically, because it is dependent on the cash flow projections in future, okay, typically a business valuation will be a range of business valuation and not only just one value which is there. Okay, or there are myths that it will be required only in certain circumstances, or business valuation will be can be done only if it is a profitable company. No, I mean, if it is not a profitable company also, the company can have solid business value. For example, a particular management is not able to run the business successfully, so it is earning losses, but otherwise it has a great potential. So the investor who is investing in that particular company will definitely look at it favorably and will still give a business valuation. And there is no need for becoming a very complex, building complex or financial model. I think many a times the business valuations are done based on benchmarking with similar kind of companies and their valuations, etc. So those are, I think, the myths, I think, which are there and which need to be dispelled. What are the issues when acquiring a capital or venture is that the buyer and seller obviously, are at, on both sides of the table. So what happens is that buyer is obviously willing to pay less price and seller wants a more price. So this is the one part. emotional bias of the seller. Many a times, especially in India, many a times I have seen examples that companies or the promoters are not ready to sell businesses, even though they may be making losses, etc. Vis-a-vis their counterparts in US, because in India the family businesses tend to hold their asset as if it is their own kind of a thing rather than letting go. So that is the thing. And most important will be reason for acquisition. So strategic investment. So many a times, I think classic example I think you must have seen is that the Walmart acquisition of say Flipkart, for example. They paid a fantastic valuation for a company which otherwise was making losses but had great revenues and customer. Because what was my purpose is to acquire this whole customer base and being a player in the market. And as you can see that now today there are only these 3 or 4 players like Reliance and Amazon and Flipkart. So that's what it is. So it's all how this thing, what are the reasons for acquisition. So that's what I was saying, that new products are expanding, new line, new technology, new market. For Walmart, this is a great new market. I mean, because somebody has already made an effort and we could just acquire that particular company. Okay. The other aspect of valuation will be that typically companies will look at the valuation because I get synergies. Many of the mergers and acquisitions are done globally because by synergizing the two businesses you will be able to save cost. Okay, optimize costs rather than any other benefits. So those are, I think, some of the benefits which are available. So what is the evaluation of an acquisition? So the most important evaluation of an acquisition will be obviously that the price which we are going to pay, how the company will be able to, or the new business which we are acquiring will be able to pay me back and over what period of time. So the faster the payback, the greater the benefit for the acquirer. Okay, so that is the thing. Amount of security, changes in the interest rate, etc., etc. The effect for valuation, then current manager's intake. Yeah, very important, and especially I think whoever is say if you are all working in a software company, you will know that many a times if it is a product company, it will actually be a brainchild of few people. Now, if that company were to say, for example, sell to another company, then what happens is that while the acquirer will get the new product, but you will lose the benefit of the knowledge which the promoter, existing promoter possesses. So if you were to go, or if all the critical employees who developed the product were to go, what will happen to this particular product? So then many a times in the pricing, you will also have what is called, retention strategy for the old promoter to stay for a certain period of time, at least in the transition period. Or you don't want them to do competing business, so there could be non-compete fees. So there are various aspects which are this thing. I think most important, obviously, when you buy a company, one thing which you will do is obviously a very thorough due diligence of the financial, the projections, the commercial viability of the project, and so on and so forth. What are the reasons for being sale? The physical condition, in the sense that if you are interested in the plant and machinery, or if you are interested in some land and buildings, then you will do a thorough search on that to see whether they are really genuine and good condition and all that, which competition that you are going to get into, and so on and so forth. Are there any hidden liabilities in the company which the acquirer doesn't even know? So that's why people do this financial and legal due diligence to assess whether there are any cases pending, whether my assets which are there are they free from encumbrances, or they are they have some liabilities attached to it. So a whole lot of stuff actually goes into a due diligence, and due diligence typically, depending on the size of company, becomes a very elaborate 2 months exercise. I think many closely held companies have shortcomings like lack of management depth, insufficient controls. I think, yeah, one of the key things which typically I think the companies also look at is that how good are the internal controls and the governance processes within the organization. That also has now started playing a very important part, because depending on the tone at the top and the governance, the companies are evaluated based on that. The better the governance, the higher the valuation. I think again there are classic examples in the stock market. You will find that the companies which have got a good governance in place will always command a premium value than the companies which do not have a good governance in place. What are the typical uh, valuation methods? Okay, so one is of course which is based on the uh, the assets, value of assets. So in the sense that if a particular company is not so profitable, then what happens is, but it has got great assets like plant and machinery, fantastic plant and all that, then people will tend to give more value to the value of assets and rather than to the profitability of the company. In that case, then what will happen is that typically the companies will actually do a fair valuation of those assets, deduct liabilities, and then you will arrive at a valuation. So that is the, I think, one critical aspect, I think, which is there. And then obviously, if you are looking at the financial statement, then there will be number of items in the financial statement, especially in the profit and loss account, which could be one-off activity. So there could be certain things which are, maybe you have to write off some expenses, which is abnormal expense and all that. So you will do all those adjustments to arrive at what is called an adjusted valuation or adjusted book value. So this is one part of the this thing. Then establishing the firm's value of the asset depends on many factors and all that, and I explained to you about the difference between the price and that. So what are the typical approaches? So one is what is called a market approach to a valuation. Second is an income approach, and the third is the cost approach. Okay. So what is market approach? So market approach includes, so there are three methods in market approach. So one is a market price method. Now this typically will be in case of listed company. For example, there is one company which is quoted on stock exchange at $25. Then obviously there is a market price which is already available. Okay. So the valuation will typically be based on the market price or comparable companies transaction. So if say there are, so I have an industry benchmark. So there is this Axis Bank and there is ICICI Bank and there is a Kotak Bank and all that. So what happens is that when I am doing a valuation, I can always peg my valuation vis-a-vis the valuation which is there in the industry benchmarks which are available. So for example, if my valuation is at say 10x of the profits, but if the industry benchmark is 15x, then obviously my company is undervalued vis-a-vis this. So this is a what is called a comparable or transaction multiple method. So these are variations of the similar kind of an approach. However, market approach is good only when you have a ready market which is available. But there are a number of cases, like especially we talked about all these entrepreneurial companies which are not listed on stock exchange. So for example, if you look at Paytm or you look at Flipkart and all that, they were not listed on the stock exchange. So how do you do a valuation? So then what is called as income approach is what helps us there. So the most popular method in income approach is of course the discounted cash flow method, which is the most often used method. Then there are others like relief from royalty method. So relief from royalty method is typically adopted, when you have an intangible asset, okay, or a product or a IP, for example. So what does that mean is that because I have a product, I will save royalty cost, which would be payable if I didn't have the that particular. So, for example, if I own if I buy a ERP, then I have to pay license fee. But if I was owning the ERP, then I don't have to pay license fee. So this is the relief from royalty method. And Black-Scholes model, which is typically a mathematical model, is adopted in terms of while valuing essentially the stock option method. And cost approach is basically an asset approach. So what happens is that, as I explained to you earlier, that typically it will be adopted when, say, my business is not that profitable, but my assets have a greater value. Then in that case, you will adopt what is called as a cost approach, which will be essentially a replacement cost or a reproduction cost. So what does that mean? Replacement cost means, now, somebody has already spent so much money there. This factory has been in existence for so many years, okay, and in this kind of a technological condition. And if I were to start the factory today, then I'll have to invest so much. So this is called what is called the replacement cost, which is what I just now explained, that I will do a fair valuation of assets, deduct liabilities, and arrive at a net book value of the asset. So these are essentially the three broad approaches in the firm's valuation. Any observations so far? Any quick observations? Hello? Hello?
Oh, yes, Professor.
No, any observations so far?
No, Professor. Can't think of.
Okay. Um, So I think I talked about this price earning valuation method. So useful in valuing publicly held corporations and which are comparable to the market price and all that stuff. But as I said that this price earning ratio or multiple earnings method do not work for a private company because they are not publicly traded. However, what I have seen, and I have seen I have done number of business valuation. Even if in a private company, suppose I were to adopt a discounted cash flow method, what will happen is that so let's say that there is one private company which is a software services company, and I do a valuation as per DCF for the discounted cash flow. But I also have a benchmark which is available that's similar kind of size of a company. Maybe there is some mid-sized company which is listed on stock exchange. It is commanding X price. Okay. So while determining our price, I can still benchmark that multiple with the price which has been arrived at. Both the buyer will do that as well as the seller will do that to ensure that the pricing which has been the intrinsic value which has been arrived based on the DCF value is more or less falling in the range. So that is how typically it is done. As I said, that discounted cash flow method is the most popular method, and the process of discounting cash flow is that you first identify the expected cash flows. You have to identify the appropriate discount rate, which is nothing but weighted average cost of capital, which I explained to you. Then reasonable life expectancy of the firm is determined, and then the valuation is done. Okay, so this is the value. So how do you, so I will now get into more in terms of this whole discussion about the DCF method, because this is one of the more popular and more difficult to understand kind of thing. So how the free cash flow is arrived at, and I talked about the free cash flow which is available to the investors into the company, is that you first take profit before interest and taxes. Okay. And why it is, so you will essentially add depreciation, because what happens is that you are arriving at a cash flow, not a profit. So depreciation is a non-cash charge to the P&L account. Okay. But I will deduct tax, because tax is actually a cash outgo. Okay. So for me to arrive at a free cash flow, most important thing is to take all cash elements into consideration and add back all non-cash elements. So by doing that, I will arrive at what is called as the net operating profit after taxes, but before depreciation. Then I will deduct what I said is the net operating working capital, which is nothing but a difference between current assets minus current liabilities. Because whatever are the current assets on the liability side also have current liabilities. So which is an outsider's liability. So the difference between the two will give me a net working capital which is required in the firm. And then every year the company needs to invest, okay, in the physical assets of the company. So if I'm a software company, then I'll have to keep buying latest laptops and latest software products. Or if I'm a manufacturing company, then I'll have to keep upgrading my plant and machinery. Or if I want to expand operations, then I'll have to keep buying new machinery, buy new land, buy new building, etc., etc. So what happens is that that particular money will come out of either the debt which I would have raised or the cash I would have generated from the company. So if I were to deduct the incremental requirement of working capital and the incremental requirement of the fixed capital, then what I will typically arrive at is the free cash flow. And this is the free cash flow which will be compared with what is called the weighted average cost of capital. Now, what is weighted average cost of capital? The weighted average cost of capital is the average rate of return required by all of the company's investors. So that means, who are the company's investors? The debt. So it could be banks are giving loan. So that is also investment in a form of an investment, though it is a debt capital. And then there could be preference capital, there could be equity shareholder. So all these three expect some return. So for example, when you go to State Bank of India, State Bank of India will say that I will give you a loan, but my rate of interest is say 12%. Now what is that 12% is the expected rate of return from the company. If I am a equity shareholder, okay, and you want me to invest in your company, then I will say that, okay, I will need so much of capital appreciation and I will need maybe 20% dividend. So this is my required rate of return, okay, as an investor, okay. So the company valuation will be higher if they exceed these two thresholds. And what you do then is that, because the companies will not only look at only equity or will not look at only debt, you will have a combination of a debt and equity. So if you see any balance sheet of a company, barring some companies like say TCS and Wipro and Infosys and all that, which will be zero debt companies because they have enough cash generated where they do not require to borrow from the outside. Most of the companies will have a debt as well as equity. So what happens is that you will arrive at a weighted average cost of capital. So if my expected rate of return for equity is say 20%, and if my debt is say 10%, okay, and if it is a 50-50, then what happens is that the weightage of these two rates will be the my weighted average cost of capital. Okay, so this is the second concept which is important. However, what is also important to understand is that expectation of return by the equity shareholder is not tax deductible. That means dividend is not tax deductible for a company. but debt is a tax deductible. So what I will do is that when I arrive at a weighted average cost of capital with regard to debt, it will be after tax. So for example, if I pay State Bank of India 10%, okay, when I debit my P&L account with that 10% interest, it is deducted while arriving at profit before tax. Okay, and I will pay tax only net profit after deducting this interest. So I get a tax benefit. So what happens is that even if, say, State Bank of India is charging me 10% interest, if my rate of tax is 30%, my effective cost of capital is only 7%. So that is how it has to be done. What are the three aspects of cash flows? So obviously the bigger the better, the sooner the better. So what happens is that, you know, you have to also understand one present value concept, that today's cash flow is more than tomorrow's cash flow, because next year's cash flow is fraught with risk. So if I were to discount it at present value, it will be at a lesser value than today's cash flow. So what happens is that the earlier the cash flow, or the earlier the cash flow, the better. Risk of cash flow, obviously the less risky the better. And all these aspects affect the business valuation. Free cash flow is cash flow available for distribution to all of company's investors, which is generated by company's operation, and weighted average cost of capital is the overall rate of return required by all of the company. The difference between the two will essentially give me the valuation. The higher the difference, the better the valuation. So this is typically the formula. Now I will not get into so much of this thing. So what is the value of business is present value of all expected future cash flows discounted at weighted average cost of capital will give me my firm's valuation. So this is the formula. So what happens is that when you look at, say, now, yeah, so I think you must be watching all these you know, stock market, say, valuations. So for example, somebody will say that, okay, Reliance is valued at, say, 2000 rupees or something like that. Now that 2000 rupees is not based on the past performance. The 2000 rupees is actually based on what are my expected cash flows from this particular company over the future period of life, not in the past. So investors will never look at past while doing a valuation. They will definitely look at past to understand the trend, but the valuation will always be based on the future expected cash flow. And this, I think, we must always keep in mind. Okay. How this, so once you arrive at a value of operations, so typically how you do it is that you will, so for me to do a projection, what generally is done is that to arrive at a free cash flow, uh, the companies will actually do a projection of future cash flows. So they will essentially prepare a profit and loss account, projected profit and loss account for next 5 years or 10 years, as the case may be. Okay. So, and the reason why nobody goes beyond 5 and 10 years is because you really can't predict, your future so much into the future. Okay. So that's why the initial valuation will be arrived at based on the the future cash flows. So the primary period will be either 5 years or 10 years. Okay, this is what it is. However, the company is not in going to be in existence only for 5 or 10 years, right? So the company will essentially will have a, or is expected to have a reasonable existence in perpetuity. So there is a primary cash flow which is either 5 or 10 years. primary valuation period, which is 5 or 10 years. And then what is also called as a terminal valuation, which is that beyond 5 or 10 years, you really cannot predict, okay, your cash flows in as greater detail as you would do in the first 5 or 10 years, because you can't predict so much. Like, say for example, in 2025 or 2030, what is going to happen, I don't know. Okay, so there, then what you do is that you do a terminal valuation of the company for cash flows, which will be, so suppose if I'm doing a DCF valuation today, I will do a projection for say 2025 or 2030, as the case may be. Okay. And after 2025 or 2030, we will assume that the company is expected to grow at say 3 or 4 or 5% over a period of a foreseeable future. And you will do a projection of that foreseeable future discounted at the present value, and that is will be called as the terminal value. So the value of operations will be combination of the discounted cash flow in the primary period and discounted of the terminal value, plus there will be certain assets in the company which will be called as what is called as idle asset or temporary assets. So for example, there could be some land which is there, but it is of no productive use, in the sense that company just bought some 20 acres of land, but it is in existence. Or company has some, mutual fund investments, etc., etc. So what you will do is that you will arrive at a primary cash flow, you will arrive at a terminal cash flow, then you will add these idle assets, okay? And then what you will typically arrive at is the value of the business. But that valuation of a business will be for the entire investor group of investors, which is debt as well as equity. So from that valuation, if you were to deduct what is my debt, okay, that is my loans payable to banks or any other debenture holders or private equity players, etc., etc., then what residual value will get is the valuation of equity, which will be available to the equity holder. So this is how the claim happens, and that's what I just explained, that debt holders will have first claim, then preferred stockholders, and then it will be to the common stockholders. So suppose if I were to have this kind of an example, that my free cash flow is say 24 million, just just for some understanding. I mean, we have to really get into, I mean, you'll have to have a maybe a separate 2 hours exercise just to understand what these business valuation concepts are, and not doing it in say 45 minutes or something like that. So suppose in an example, I have 24 million as the free cash flow, weighted average cost is 11%. And as I said that these future cash flows are expected to grow at 5%, then so much of marketable security, so much is the debt on the balance sheet, so much is the preferred stock, and the common stock is say 10 million. If I were to take examples like this and put it into this particular formula which we just now discussed, this is how the valuation will be. So typically, if you were to look at that, what is this 24 million? 24 million is the free cash flow. Okay, 1 plus G, which is a formula, 0.5. 0.5 is the expected growth. So this 24 million is expected to grow at a constant rate of say 0.5. This is an example. In practice, it doesn't happen that way. Okay. So this divided by weighted average cost of capital. Okay. So free cash flow is my own rate of return. 0.11 is the rate of return expected from this particular business minus the growth rate. Okay, if I were to solve this particular problem, okay, then the valuation of the company will be $420 million. Now, this particular valuation which is arrived at, where the assumption is that today whatever cash flow that I have arrived at, so for example now in say TCS for example, this year they had a profit of say maybe 10,000 crores. Okay. Now what I am saying is that I am assuming that till perpetuity, like say for next 50 years, TCS will have growing the profit at the rate of 5%. But in the reality, it doesn't happen that way. So this is a simplified version of that. So this 420 is my primary valuation. Then what I will do is that I'll add marketable securities. Okay. So which will give me a valuation of 520. Then I will deduct debt, right? Because this is to a third party. This is to outsiders, not to equity shareholders. Okay. And then I will deduct preferred stock 50 to arrive at a value of equity. And why I'm doing that is this is the hierarchy. That out of free cash flow and the value which I arrived at, I will first deduct debt, then I'll deduct the preference shareholders, and whatever is the residual value is what is required to the shareholder. Now I have number of shares which are outstanding is 10 million number of shares. So 270 divided by 10 will be $27. So $27 will be my valuation of equity per share. Okay. So if say for example Reliance equity today or yesterday or Friday it was say 2,300, then 2,300 Reliance equity is actually equivalent to PO. PO of in this particular formula was for Reliance was 2,345. So this is what is the constant this thing. However, as I told you that the life is never constant. Okay. So what happens is that then I need to do projections, and I told you about that 5 years or 10 years as the case may be. So what happens is that you have to do a projection of free cash flow over 3, 5 or 10 years as the case may be. And as I told you that you will not be able to go beyond 5 or 10 years with any kind of reasonable accuracy for predicting cash flows in future, because you can't see so much in the future because there is so much of uncertainty around that particular point of time. Okay. So in that particular situation, what you will do is that you will arrive at what is called this horizon value formula. So I told you about this primary cash flow discounting, which is the primary period of projections, which is in this example it is 3, but in normal it will be 5 or 10 years as the case may be. And then they are saying in this example that this company after 3 years will perpetually grow at the rate of 5%, till say maybe 30 or 40 years. And anybody, I think, if you have studied the corporate finance, you will realize that cash flows which come out of after 10 or 15 years literally start losing its entire value, because the discounting of that to the present value will be very minuscule. Okay, so so you will then arrive at the horizon value, which is called terminal value. Okay, so in this particular example, for example, now you look at it this way, that 10, 20, 35 is my cash flows, and then this is a constant growth at 5%. Okay, so this 10, 25 and 35 will be discounted at the rate of 10%, because there is no change in the WACC. So WACC for is 11%. So if I were to discount 10 million, 25 million and 35 million over 3 years time frame. First year discounting of 11% will give me $9 million. 25 million at 11% over 2 years will give me present value of 16. 35 million over 3 years will give me a present value of $26 million. Okay, and then after 3 years, I have a horizon value concept. This is the formula for horizon value this thing. So this is FCFT 1 plus growth, which is 1 plus 5%, WACC 11 minus 5%. Okay, so this is what it is. So after 35 at 5%, it will be 36.75 will be my this thing, my cash flow in the fourth year, divided by 0.11 minus 0.05 will be 0.06. And if you were to arrive at the valuation, the terminal value will be 612. Primary valuation will be 400 and and then 612 discounted. So the $612.5 million is the valuation arrived at the end of 3 years. Okay, that $612 million, you will discount it to the present value to come at the value in zero, which again you will do it at 11% WACC. So that $612 million, the present value will be $447 million. And if you add to the primary cash flows, my valuation will be $480 million. And again, the same example, short-term investments I'll add because it is an excess asset. I will deduct debt, I will deduct preferred stock to arrive at the valuation and this. So this valuation of 33 is actually completely different than this valuation of 27, because this valuation talked about only a constant growth of 5% after first year itself. Whereas in this case, I did primary projections and then after that it was 5%. So the valuation actually became more accurate at $33. And as I told you that even after doing a discounted cash flow method, you can still arrive at, you can still use the other methods like price earning method, multiple stock exchanges. For example, say TCS is traded at say 20x, for example, so its price is 20x of its earning. Now, if I'm doing a valuation, of a software company, I arrive at say $20 million valuation, which actually gives me a 15x valuation, so 15x of my earning. TCS is at 20x. Now, can I say that, okay, no, my valuation also should be at 20x? The answer is no, because TCS is in a different growth path, different period of stability than my company is. But at least it gives me enough indication as to whether my valuation, which I have arrived at, is fair or not. Any questions, any views, any concerns? Hello?
Yeah, sir. Sir, that share price, last one you said $33.
Yes.
Is that going to be after 3 years or it is the current value?
No, it is a present value. It is a present value.
Okay.
It is at year zero.
Okay. And this
so what happens is, so if you look at this table. This table is important. Okay. Year 1, my cash flow is 10. Year 2, 20. Year 3, 35. And after third year, I'm saying that this 35 will keep growing at 5% per annum, right? So this is what is called, then the fourth column is what is called the terminal or the horizon value. Okay. Now each of these 10, 20, 35, I have discounted it at 11%. Okay. And there is a table. I mean, you know that discounting table. Okay. So if you refer to that table, you will get these values that $10 discounted at, whatever, 11% will give me $9 as the fair value. $20 after 2 years will be 80. I mean, whatever this, maybe it is zero point 0.8 or 0.85 or something like that. So it will give me 16. 0.35 will be discounted at say zero point 0.8, for example. Then it will be 25. And perpetual, for that there is a formula which is nothing but cash flow in the horizon period, the first year after horizon, I mean, first year after primary period of cash flow divided by expected return by all investors minus constant growth will give me a terminal value at the end of 3 years. Terminal value, so this 612 which is arrived at is at the end of 3 years, not at the end of 0 year. That 612 you will discount it at the same rate at which you have discounted $35 million. Okay.
Okay.
And then that amount will come to 447. And total of all these is my primary value. Now in that I will add idle asset. So I had this marketable security, which is actually idle cash. I mean, they may have invested in some fixed deposit or something like that. So this is 100. So my total value is actually 580. Okay. Then what happens is that I have to arrive at the value of equity per equity value. So then I will deduct first debt, because debt is a third party debt. Then I will deduct preference capital, because I am not going to share my profits to preference share capital at all. I will give them only fixed rate of dividend, and that's the end of it. And then I will arrive at a value of equity, which is at period 0, not at period 3. Okay.
Yeah. Sir, this is as per the books. Market value will be something different. It cannot
No,
be
no.
at
So this is no. This is not as per books. This is this is a fair value which you have arrived at. Okay. Your price could be different. Your price could be based on the demand and supply.
Correct. Okay.
Okay. Or say, for example, if you are a investor and you are really desperate to get this. Now let's say take an example of this company. So the market value or fair market value I have arrived at is $33. Okay. But you say that no, I want this company at any cost. So I'll give you $40. Now that is a price.
So understood.
Okay.
Understood, sir.
So price and fair value can be two different things, or rather they are always two different things, because many times what people will say is that, okay, now this discounted cash flow I have read at $33, but you give me 20% premium to this particular number, because you are going to get, say, maybe controlling stake in the company, or you will get a board seat, or you will get this market share, and so on and so forth. And that is how it is arrived.
Yes, sir. Thank you.
So this is the same thing I am talking about. This often use PE multiple. So you will also do PE multiple. So after arriving at, then it's all a question of negotiation. You will say, no, but I think TCS is quoted at 20x, so why not, give me 18x, for example, even though this valuation may give me 15x. So that's fine. But then that is a price between two buyers, two parties, buyer and seller. And then there are various methods of doing these multiples. Multiples can be based on EBITDA, now sales. So for example, I mean, if you were to look at all these e-commerce companies, none of them are making profits. Though in that case, I think it's you can take any article or, in the newspaper or in magazines, you will find that they have been valued more on the basis of number of customers on top line rather than the bottom line. So you can choose what do you want? I mean, ultimately it is between the buyer and the seller. So it's the same thing I'm talking about. So this is what, again, this particular thing that, for example, the average PE ratio could be 20, but the range could be 10 to 50. So how do I place it? So then so what happens is that valuation doesn't remain only a very kind of a broad exercise, but you have to go deep and see nobody is going to pay you more than what you believe this company is worth. So what happens is that, let's say, suppose if you were a seller and you were to say that no, I must get 25x, the seller will do, I mean, the buyer will do whole lot of analysis to come to a conclusion whether 25 is the fair price or you need to stick to. I mean, suppose if you keep insisting that it has to be 25, but he says that after so much of detailed analysis, we still believe this is only worth 20, you will walk away. You will say this deal doesn't happen. That's it. And preferred stock, this is the thing. Preferred stock is very easy because what happens is that there is no risk. I mean, it is more risky than debt, but it is not as risky as as equity. So what happens is that, and typically dividend, preference dividend, you will pay only a fixed rate of return. So generally you will find that preference shares will typically carry 6%, 7% and all that. So so if my expected rate of return from the preference share is 7% and somebody is giving $2.10, so then maybe it is valued at $38. So it's a very simple exercise of preferred stock. And there is no taxation involved because preferred stock dividend is not tax deductible at all. Okay, I told you about this. I think I will, because I think we have still got one more topic to cover. I think I will not get so much into this thing. But as I told you that there are two methods of two valuations. One is a firm valuation and one is a equity. Firm valuation includes debt and equity both. Okay, because it is the valuation of a firm. Okay, where two stakeholders are involved. Okay, debt holders and equity holders and preference holders also. Okay, but equity valuation is net. That is firm valuation minus debt minus preference capital is equity value. Of course, the DCF valuation, that is discounted cash flow, is the most popular valuation methodology. Okay. So what happens is that, but it is fraught with a lot of things. So what happens is that you cannot just take DCF value as the benchmark and say that, okay, now I will not look at other multiples and all that, because what happens is that suppose if I am in a cyclical industry or my company's steel industry faces a lot of problems, and now for example telecom industry is facing a lot of problems. So telecom was doing very well 4 years back. Now it is languishing because of all these these dues related dispute and all that stuff. So how do I do that? So I have to do a lot of adjustments to arrive at as to what is the potential of this particular company. So to that extent, in DCF, lot of judgment is involved, lot of estimation is involved. So it is not a very easy method to adopt, but it is the most popular method and the most respected method. Okay, valuation challenges in COVID, I told you that, but I think you can see that our stock market is kind of bucked that whole trend. I mean, both stock markets are going up, like Dow Jones is also going up and Indian market is also going up. The reason being that, again, as I told you, but it is not so much of the today's reality, but it is what is going to happen in future. So as I said, this is a classic example to prove that investors value the companies or stock based on the future value, not based on the past. This is a classic example that our market is going up, even though the GDP was down 24% last quarter. What does that mean? that they are actually already started looking at what will happen in 21, 22 and not in 2020. So that is the thing. Okay, then these are the typically how the valuations. After valuation, then buyer and seller will typically first enter into a letter of intent, which is essentially a non-binding agreement. Then the buyer will actually do due diligence. Okay, and after doing the due diligence, then only so letter of intent is nothing but a virtual replica of shareholders agreement, except that will not be final, in the sense that even after this stage, if the things don't work out, you can still walk away. Okay, so typically all the aspects which need to be put into the final shareholders agreement will be put in terms of valuation, dilution of equity, liquidity preference, dividend preference, conversion right, what will be the voting rights for the buyer. Okay, so in case another shareholder is there, can he sell to another third party, or first they have to give rights to the existing investors? So that is called what is called as a right of first refusal. Piggyback rights. Piggyback right means I'm piggyback on somebody else's rights. So you give me those rights. Okay. So for example, there are big investors and there are smaller investors in a company. So typically, a smaller investors will piggyback on bigger investors. So those are called piggyback rights, like that. So I think the most important thing is this whole founder or the promoter stock. So what happens is that most of the investors, when they come into a existing company, they would want to bind the promoters. So the binding of promoters and putting a non-liquidity clause for promoter stake, I think, is one of the key criteria in all the agreements. And they will actually force the promoters not to sell below a particular number unless certain things have been established. So these are all the terms essentially which are covered. And what are the other factors to consider? Obviously, buyers are, as I told you, that if somebody is desperate to get into market, you are doing it because you avoid the whole gamut of running the business and growing it for last 10 years, because you will always get a ready-made business. It will always depend on the accuracy of the projections, and the projections become far less accurate as you go further into the future. And the degree of control, the more the control, the higher the premium in a business. So this is the valuation discussion. Any views? Any queries?
Professor, basically, who is responsible for this valuation, the buyer or seller, or is that third party who does it?
No, so two things. One is that first and foremost, as a seller, you need to know what is your business's worth. Okay. So you do your own set of valuation. Okay. Then buyer will appoint their own valuer. Okay. And then typically they will do a valuation. Okay. So what happens is that generally, I mean, if a business is small, only one valuer will be enough. But seller will do their valuation only for internal purposes. In the sense, when I'm doing a negotiation, I need to know what my business is worth. So that valuation will typically be for my internal consumption. What the buyer will appoint for the valuation, that valuation will be the basis for him to come to the company to negotiate. So that is how typically it will be. But many cases, what happens is that in a dispute, you will find that in number of situations, courts will actually appoint a valuer. Okay. Then whoever is appointed by court, so that valuer will become like an umpire. I mean, and his valuation, when it is submitted to court, will be the final valuation. So there are at least two valuers or three. But so what happens is that there is no hard and fast rule, but you want some third party to do a valuation, right? Because if you do internal valuation means there could be some bias. So by appointing a good third party valuer, you try to eliminate that bias.
Got it, Professor. Thank you. Professor, I have one more doubt.
Yeah,
This is about the previous chapter about the crowdfunding. What are the
yes.
regulations in place as of now for crowdfunding? Is there any
No,
regulation?
so there are no regulations, because that way what happens is that, so typically if you see that any domestic company, okay,
Okay.
as long as there is no foreign investment into that particular company, barring maybe like say some defense or some atomic energy and all that, I think there is no restriction for anybody to invest in any company. Okay, and if you look at say foreign investment also, barring some sectors where there will be some sectoral caps, like say insurance or maybe telecom, 74% and all.
Yeah.
Then in manufacturing or in say IT services company, you can have 100% foreign investment. So there are no regulations on this particular aspect. And crowdfunding in India is actually a very novel concept. I mean, it is not even started. There are no kind of there are no restriction. But if you were to look at say, if I were to start my fund, okay, like say there are number of startup funds, private equity fund, venture capital fund. Then there are regulations. Then I have to register with Securities Exchange Board of India.
Okay. Okay. Got it, Professor. Thank you.
Sir, can you explain intrinsic value slide, sir, the first one in this session?
Yeah, sure. Yeah. So as I said, intrinsic value is the inherent value of the company. Okay. Now, how you arrive at that intrinsic value is that, I mean, what my business? My business is to generate sales. So sales revenue minus operating cost, okay, is I will arrive at a profit before tax, right? So say revenue minus cost will be profit. Okay. So that typically profit will be before tax. Now, one of the element of cost will be depreciation also. But if you look at it, depreciation on assets is not a cash item. I'm not paying for it, but it is actually an amortization. So it is a non-cash item. So I will add depreciation, okay, to arrive at the operating cost. But tax I will deduct, okay, because tax is nothing but a cost to the company. Okay, I'm paying cash, because when I pay income tax, I mean it is a cash outgo, so I have to. So it is a cost to the company. So once I put that, I will arrive at. So this is what is then the profit before, profit after tax, but plus depreciation. From that, you will remove or you will deduct what is net investment required in your working capital and your fixed capital, which is nothing but, so last year, suppose, my investment in fixed asset was 100. This year it is 120. That means I am going to put 20 rupees extra in this particular year, which will typically go out of my free cash flow. Okay. And suppose my total current assets were 100 rupees and my liability was 80 rupees, then I have a 20 rupees as a working capital, and my last year's working capital was say 18 rupees. Then 2 rupees is my incremental net working capital this year. So 18 plus 2, 20 rupees is my total investment which I will make in this particular, which will go out of the free cash flow. So profit before tax, profit after tax plus depreciation minus investment into my incremental investment into my company will give me free cash flow. This is the first concept. Second concept is that that what is the expected return, okay, from my company. So you look at it this way. I think, suppose if you want to invest in a particular company, so let's say that you are looking at the stock market and you find that State Bank of India is, say, 190 rupees value. So you will take a decision, is 190 okay or is 190 not okay? Okay. We will not just go blindly and invest in 190 rupees, right? I think we will do some analysis to see that whether is it highly priced or whether I should wait for the stock to go to 180. Now this discussion or this thought process in the investor is what is called as a required rate of return. So why I'm saying I'm ready to pay 150 and not 190, because my expected rate of return from this particular company is so much. Okay, this is what I want from this company before I shell out this money. Okay, and the more the gap between free cash flow and the weighted average cost of capital, the higher the valuation. Okay, and how I will arrive at a weighted average cost of capital? It is a combination of debt and equity. So any company, if you see, will have a long-term loan and will have equity, will have a working capital loan, and so on and so forth. So for a debt, there is a cost, say, of 12%. For equity, expected rate of dividend is, say, 20%. So, and then the ratio is, say, 1:1. Okay. Then the weighted average of the two, which is 20 plus 12, 32 divided by 2, 16%, theoretically is my weighted average cost of capital. But no, this is actually wrong, because my debt is actually tax deductible. So I will actually get 30% benefit by investing, by getting more, by getting loan. Okay, because my interest is tax deductible. So what happens is that then I will say that expected rate of return from debt by an investor is 12%, but after tax actually it is 12 minus 30%, which is, say, maybe whatever, 8 rupees. So
Yeah.
8 plus 20, which is 28 divided by 2, if it is 1:1, 14% will be my weighted average cost of capital. If my free cash flow give me a return of 20%, the gap between the two, which actually will drive my value. Is that okay?
Yeah, sir. And also, if you could see telecom companies, sir, because of this AGR dues, Airtel and Vodafone both are under
Correct.
loss of about 20-30,000 crore per annum.
Correct.
In this case, if you do this kind of calculation, will not actually work out. But
That is the thing. So that is why one of the limitations of DCF is, that this one, that when cash flows are positive, then it becomes better, but when the cash flows are fluctuating so much, like in case of now Vodafone, there's some 20,000 crore loss, or I think Airtel also showed some 15,000 crore loss. No, but that their share price doesn't reflect that. So if you see that my Airtel price is still some, I don't know what is, some 180 rupees and all, because people, when they are valuing, okay, they are actually eliminating these one-off charges. So they are looking at the future cash flow, which is net of these abnormal expenses, right?
correct, sir. Yeah.
But they are also factoring because the amount is so significant that they are also worried. The investors are also worried that whether these companies will survive in this particular form. Obviously, Airtel and all not, but Vodafone definitely, because their share price is only some 10 rupees. So what happens is my business risk has gone up so much that my risk premium is very high. So that's why, so normal circumstances, maybe Airtel could have been, say, I don't know, say 2x of what it is today. We don't know, but that could be possible.
Okay, thank you, sir.
So this is the thing. Now, I think the problem for us is that this is one more session, and but we have less time. So So what I will do, if it is okay with you, I will only concentrate on this ratio analysis. Is that all right with you? Hello? Hello?
Professor, so what else we are missing out here? Like to
No,
just
so here now we will be discussing two, three things. One, financial statement. What is a typical financial statement? That is one. Second thing is that flavor, but not in great depth, only flavor. Flavor of financial statement, flavor of typical budgeting and exercises, and flavor of ratio analysis.
sure, Professor, because
These are essentially financial.
ratio analysis
Sorry.
was covered in a couple of chapters in our corporate finance or even in our first trimester. So I just want
Okay.
to tell you that. That's also, Professor.
Okay. So which one you want to? I can quickly run you through these things.
Professor, budgeting is something very new for us.
Okay, fine. So I think let's look at it this one. So now I think this particular first slide, I will not get too much into the financial statement, but what happens there is that now today, if you see that, if you look at any financial statements, India has actually now gone to what is called Global International Financial Reporting Standard. Okay. So our balance sheet, profit and loss account, our cash flows do not look the same as they were in say 2016 or 2015, because from 2017 onwards we have adopted what is called Indian accounting standard, which are akin to global international financial reporting standard. So I think this is one part that I thought that I will bring it to your attention. What formats that you have in this particular example are all old, and while they are relevant for certain companies. Okay, the other aspect which has happened is that so there are now two types of accounting standards in India. One, there are two types of companies. One, any company which is below 250 crores net worth will have old accounting standard, and any company which is above 250 crores net worth will have this IFRS or Indian accounting standard. So while some accounting standards which are shown here, these are of course the some examples which are taken from the foreign author's book, but Indian also old accounting standards are more or less the same, but they are not same. So if you look at say any balance sheet of Infosys or Wipro and all that now, it is completely different than what their balance sheet used to look like in 2015-16. So this is I thought I'll just give you one flavor. We will not get too much into detail. So there are four components of that: balance sheet, profit and loss account, what is called is statement of changes in equity, and very important is statement of cash flow. So what happens is that many a times the profit which is arrived at in the profit and loss account, while it is very important, does not give a picture of what is the cash generated by the business. So cash flow will actually help you in identifying what is cash generated by the business. And typically a statement of cash flows will be divided into these three or four components. So one, the cash flow statement will typically have cash generated from operating activities, generated from companies' investment activities, and cash generated from companies' financing activity. Cash flows in or out. So if you have borrowed more than what you have repaid, then you will, so suppose if you have repaid more rather than borrowed, then it will be cash used in financing activity because you have repaid more than this. So this actually gives a very nice picture about what is the cash generated rather than what was the profit generated. Okay. Now these are the budgets. Okay. So what happens is that there are these three or four types of three budgets essentially which a company prepares. One is an operating budget, second is a cash budget, and the third is the capital. Okay. So operating budget is nothing but, I mean, I talked to you about this projected cash flow, projected profit and loss account. Same thing is this. So cash budget is nothing but a projected cash flow statement over say next 5 years or over the next 10 years. And capital budget is definitely the one which is very important because it actually evaluates all the investments which the company is going to make. So operating budget, one of the key, so operating budget is arrived at based on what? So I must have a budget for revenue and budget for expenses. So budget for revenue, there are various statistical tools which are available, and I'll not get into too much of that, but I will only explain to you concept. So how do I do sales forecasting for next year, for example, or 3 years down the line or 4 years down the line? I have to do certain, what you could do is that certain statistical or regression analysis I can do, where I bring some assumptions into the picture. So for example, if I were to spend $1 million or say 100 crores in say advertisement for next year, then it is expected to give me 500 crores of incremental revenue. Okay. So before I even do that, I must have a sense of whether 100 crores will give me 500 crores of revenue. So I then fall back on my past to see that how effective my advertisement expenses were in generally generating sales for. So there are various ways and means in which I can do sales forecasting. One of the ways of doing is to do this linear regression, where y is a dependent variable, which is essentially nothing but the sales, and a is a constant. I mean, you have to have some constant saying that, okay, this is what is the amount which will be minimum spent on some of the activities. Okay. And then there are these dependent variables. So in my example, for example, X will be like, say, advertisement expenses. And then that X, uh, you know, so when I arrive at Y, okay, so 50 rupees of advertisement expense is going to give me how much of revenue. So I must have some expectation of that. So I will say 50 rupees of advertisement expenditure should give me 5 times the revenue. Now that 5 is nothing but that B. Okay. So this formula, okay, if it is plotted over this particular line, will actually give me a regression analysis. Okay. So what happens is on the y-axis I have sales, and on the x-axis I have advertisement expenditure. So then what I do is that I keep predicting. So for 100, if I were to move from 50 to 100, my sales will go up by 100. If I move from 100 rupees to 150, my sales will again incrementally go by 100, and so on and so forth. And actually plot a regression. So what happens is, now this is a very simple calculation, but if I have a variables, what happens is that you will actually have these small, uh, you know, uh, dots actually, which will dot the whole, and what you will need to do is that you will have to draw a common line between those to understand as to what is the trend which is being seen, and that trend analysis is what is going to be called as the regression analysis. Okay, so this is how you typically do. So this is like one of the methodology for doing a projection. Okay, so what you will happen is that, now this is a very simple example, but you will have, say, hundreds of data points and hundreds and many kind of permutations and combination, which will be typically dotting the whole chart here. But what you have to do is that you have to find a common thread, and you have to put that common thread through a line called the regression line. And this is what actually will help you in doing a more scientific projection. So this is the typical example that I think in January my sales was so much, so I expected to grow at 5% compound. So so January became 315, then February sales. So in 2000, say for example, now these 300, 350, 400, like last year, I say that I had this kind of a range of revenues. So I expect 5% increase. So this is how I will do the projections. And then after doing that projection, then I will also do projection of gross margin. And how I will do projection of gross margin is by projecting in over the period of next 12 months or next, depending on what period the budget I'm preparing. So whether I'm preparing budget for 1 year, 2 years, 3 years, it will all depend on that. And what is that? That the gross margin when I'm predicting, I will also take into consideration what was the gross margin which was achieved last year. Okay. And then what somebody might say that, okay, last year my gross margin was 20%, but I want to become more profitable. I want to target 25% gross margin. So how do I achieve that 25% gross margin? Is a combination of various factors. By increasing sales, by increasing volume, by increasing price, by bringing efficiencies in the way I goods. Okay. Maybe I think, so you need to really analyze greater in detail. You may come to a conclusion that, you have actually bought, I mean, you used to buy material from only one source, but you didn't really figure out that there were other 2, 3 vendors which were giving the same quality but at a lower price. Okay, you do that exercise and then you try to do that. So in the projections or in the budgeting, lot of effort goes. I mean, if you look at all the big companies, I think if it's a so companies which have say March 2020 as the year end, I'll tell you their forecast for 2021 would have started in January, February kind of a time frame only, because just 1 or 2 months goes in, refining your business plan. So you will first arrive at the gross profit, and in that, one of the most trickiest thing will be how do I do gross margin projection. Okay, and many companies will also set a higher target just to push people to achieve those higher targets. That is what also is goes into the projection. So this is just a production. So now, before I come to even sales, I need to know how much for me to generate so much of sale, how much action also then. So the production budget from the production budget. Okay. So that is the how production budget will come in. Then you have cash flow. So this is the how you will prepare the gross margin and the uh, sales and forecast purchase budget. And then after this, you will typically do a expenditure budgeting also, which I will explain to you. So this is a cash flow budget. So cash flow budget uh, essentially will provide an overview of the what is my projected cash flows. Now, why I require at what point of time I need to pay what liabilities, how much debt I need to pay to my lenders, for example, so State Bank of India and all that. At what point of time certain investments are going to come, okay, and so on and so forth. What are the tax payments we need to do over say next 1 or 2 years? What is the GST that we need to pay over 1 or 2 years, etc., etc. So it is extremely important that we need to do cash flow projections. And cash flow projections will have combination of 2, 3, as I mentioned, which is cash generated from operating activity, cash generated from financing activity. So how much you are going to borrow to invest in, say, for example, capital budget. Okay, so this will also form part of a cash flow budgeting. And how much loan I need to pay, because I have already got a covenant, to pay those loans as per the agreement. The loan repayment also will form part of the cash flow budget. And how much is the minimum cash balance which I require? Cash means not just the cash in the hand, but in my bank, etc., etc., to meet my immediate liabilities. And here the most tricky part is that I have to balance between cash out. I mean, in the sense that it should not be too low key, I renege on my payments, especially statutory payments, which will force me to into penal consequences. But I should not have too large a cash balance where I lose the investment opportunities. So it is a beautiful balancing act which I need to do while preparing the cash budget. Okay, so this is what essentially covers the some of the critical aspects of cash flow: revenue, operating margin, and investment efficiency. Okay, so revenue prediction from existing and new customer, new referral, new products and services, and pricing strategy will essentially determine the revenue projection. Operating margins, as I told you, better vendor deals means better pricing. Buying efficiency, am I buying from the suppliers who are in Bangalore, or am I necessarily buying from somebody in Delhi? Marketing and digital. Now, if you see that many of the companies are resorting to digital marketing to reduce significant spend, which is spent on the, advertisement and so on and so on. So you have to constantly keep thinking about it, payroll management, etc., etc. And then investment efficiency. I mean, how good is investment? So whenever I'm investing in capital, is there an overrun of expenditure? Is there an overrun of this thing? Am I doing my capital budgeting efficiently or not? Will be the very critical and very important aspect in cash flow. Working capital financing policy is one very important aspect in, and I'm sure I think you must have learned in cash flow, I mean, in corporate finance. So this particular diagram actually shows you that typically an ideal situation should be that all my long-term investment should come out of my long-term liabilities or long-term fundraise, and all my short-term investment should come from short-term liabilities. If I have a mismatch there, that especially if I were to borrow say working capital, and if I were to invest, or if I were to construct a factory building out of it, one, it will be a violation of the agreement with the banker. And second thing is that while banker will insist on its payment after 1 year, but you would have locked that money into investment which is only going to give you a return after 5 years, and then you will essentially be staring at a liquidation problem. This particular thing actually depicts the working capital efficiency around this. So these is how the expense and operating budgets are prepared. Now, I will not go into too much detail because it is nothing but anticipated operating expenses and all that. So while putting this entire budget in place, what goes into great detail is what are the assumptions based on which these budgets are prepared will be very important. Okay. The other aspect I think which you all need to take into consideration is that expenditure is divided into essentially three elements. There are expenses which are fixed in nature, no matter whether you do zero revenue. Say, for example, now car companies did not do any revenue in March, April, or April, May, for example. But they had to run plant, they had to run some minimum air conditioning, they had to maintain plant and machinery. That is all fixed cost. Okay. But there are certain expenses which vary with the volume. So, for example, when they had zero sales, then they had zero purchases. Okay. So that is a variable cost. But there is another line which is called uh, semi-variable expenses, which is very important. That there are certain expenses which will vary, okay, depending on the volume of activity. So, for example, so I have rented a premises for logistics. Now that particular thing is okay for when my production is 10,000 unit, but once the production goes to 15,000 units, I may need another warehouse. So then that particular item or aspect is a semi-variable. So prediction of semi-variable and putting it here is extremely important for this, especially for arriving at marginal costing and gross margin analysis. So this is typically the cash budget, So what happens is the difference between this expense budget and cash budget is that expense budget takes into consideration expenditure incurred during the year, whether the cash is paid or not. That budget gets converted into cash, but you only put those items where you have received cash or you have paid cash. That there is a difference between the two. It is actually difference between fund flow and a cash flow. So sales, for example, how will you arrive at? So my sales were 315 rupees in this example, but my cash receipt is 360 because cash includes prior period's cash receipt of 82 rupees, 26 rupees of previous years, okay, and some portion of this month's cash will come only in February or March. So it is a cash versus accrual concept. I think this is what is the key. And then of course you prepare this. Once you prepare all these budgets, which is essentially production budget, cash budget, operating budget, then what you prepare is the pro forma statement, which is nothing but firm's balance sheet and profit and loss account over 1 year. So this is the typically how the so these are all pro forma statements. So one is so all these activities culminate into preparing 12 months P&L account, projected P&L, and 12 months projected balance sheet. This becomes your basis for budgeted over next 1 year. Capital budgeting is essentially required because obviously capital budgeting means it is very capital intensive. I mean, you imagine that you want to spend say 100, 200,000 crores, 5,000 crores in your plant and machinery, in your factory. You want to set up a steel factory in say Orissa, for example. I mean, it's not an easy task, and you cannot do that unless you do what is called a capital budgeting exercise. And for me to do that exercise, that when I want to set up, say, such a, I want to make an investment of such a magnitude, what is extremely important is for me to assess what is going to be the return on the capital which I am going to invest, what is going to be the payback period. So what happens is that depending on the size of the company, you could have one project or you could have a multiple of competing projects. So for example, you may have a choice of setting up a factory in say Orissa or in its neighboring state. Now, am I going to put factory in both the states or am I going to make an evaluation or a selection of the two projects? Okay. Or if I want to expand in Gulf, okay, do I want to set up a factory in Oman or do I want to set up a factory in Dubai or do I want to set up a factory in both the places? Now this particular selection will be extremely critical, and there are various methods by which you arrive at this thing. So if you look at it, that one of the critical aspects which is very important is that expected return uh, from the investment, okay, net of tax plus depreciation. And I think I explained to you that concept in the free cash flow, that profit after tax plus depreciation is my expected return from an investment, and that is going to be the most critical. Now, if I were to look at this particular example, you will find that in proposal A, I have 500 rupees generated in first, 400, 300, 20, and 10 rupees. Cash is generated from this proposal in one, and proposal B gives me the same amount. Okay, but here I get first year 100 rupees, second year 200, third year 300, 400, 500. So here my total is 12, 14, 15. Here my total is 9, 12, 12, 30. So here I have got a 1500 crore, $1,500 if I have got a $1,200. Now if I want to choose the two, which one I should choose? $1,500 or $1,200? Now that is going to be an evaluation exercise. So if I were to look at it, I will see that actually proposal A gives me higher cash flow earlier than in the proposal B. So if I were to discount these at the present value, it is quite likely that even though proposal A over a period of 5 years gives me only $1,200, could actually become more profitable because it is actually giving me higher cash flow first. And as I told you in my earlier slide also, the earlier the cash flow, the better. So this is how the evaluation goes into the capital budgeting. So there, what are the methods which are used in capital budgeting? So one is, of course, this what is called the payback period. Okay. So payback period is nothing but in how many years, okay, my investment will be equated with my payback from the project. So if I invest 100 rupees, I say that, okay, in 3 years I recover 100 rupees, then and I have another project which gives me the same payback in 4 years, then I will say that I will select a project which gives me a payback in 3 years versus some project which is give me in 4 years. So that is a selection which is done to payback period. However, this particular simple example gives you one picture that it actually doesn't cover the cash flows which are beyond payback period. So after 3 years cash flow or after 4 years cash flow, I completely ignore. That is one. Second thing is that I also ignore the discounting factor. So I actually take absolute number and take a total, okay, which actually is not correct. So what happens is that the more refined version of capital budgeting will be to do net present value method. So net present value method means in net present, I mean in net, so it will essentially be akin to, what I explained to you about the discounted cash flow method. Okay. So what I will do is that from this particular project over say next 5 to 10 years, what is the projected cash flow? And if I were to discount it and then compare 2 or 3 proposals which I have with me, then that will actually give me a better answer. And then that amount, the higher the net present value. So say let's say that there are 2 proposals, each of 1,000 rupees. One gives me a net present value of 1,200 rupees. One gives me a net present value of 1,300 rupees. Then what I will say is that I will choose the one which is giving me a net present value of 300 rupees because that is giving me a higher net present. There is another method which is adopted called internal rate of return method. Internal rate of return method is nothing but a 1 divided by NPV method. Okay. So NPV method actually what it says is that higher the net present value, the better the chances of the selection. In case of IRR, what it does is that it actually equates the future cash flows to the to the cost of investment. So in IRR, the shorter the period, the better the chances of the selection. So it is nothing but just a reversal of net present value. And then there is another variation called contribution margin. As I told you that one of the most important aspect in financial management is this break-even analysis. Okay, or contribution, and contribution margin takes into consideration what is called a difference between selling and variable cost. Okay, because my fixed costs are the same. Okay, for a particular stated activity. So then how I manage the difference between selling and variable cost, which is essentially the gross margin, will essentially determine the selection of the project. So the higher the gross margin, the higher the marginal gross margin, increment in margin, the better it is for me, because my fixed costs are going to remain the same. And as I told you that the break-even point is the one where you will equate the selling price minus variable cost per unit, okay, which is a gross margin, will essentially give you a break-even point. So the break-even point will be that gross margin amount which equates with my fixed cost. Okay, so after that particular point, whatever production happens, okay, I will continue to add more and more profits to the profit and loss. Okay, so this is what is called and this is extremely important. And as I told you that one more variation we need to do is that I cannot take costs only as variable cost and only as fixed cost, because there is another component called semi-variable cost. So I have seen number of cases where the decisions have actually gone haywire because you did not do this particular exercise properly. So if you were to split semi-variable cost properly, your decision making becomes much better. So this is what is called, so questionable costs are nothing but these semi-variable costs. Okay, so this is how the the graphic presentations are there. So if I'm going to look at the gross margin from a particular project, okay, you look at this, that fixed cost is constant, okay, over a period of these units. So what I'm saying is that whether I produce 0 or whether I produce 500 units, my fixed cost remains the same. So it is all the same. Then my variable cost essentially moves in tune with my sales. Okay. And my total cost line is drawn, which is a total of total fixed and variable cost. However, in this particular diagram, again, it is a very simplified version. What you also need to do is take another element, which is a semi-variable cost, split those semi-variable costs into variable and fixed, and then refine this entire thing. That will actually give you a better picture. So what happens is that what could become a variable cost for me in one set of business could be a fixed cost for me in another set of business. That is the critical part of it. Or I also have, say for example, I gave you example of, say, typical investment into fixed assets. Okay. So I set up a factory to manufacture, say, 200,000 units. But if I want to increase it to 250,000 units, I need to invest more. And then whatever expenditure I incur, operating expenditure, to achieve that incremental 50,000 operating activity will essentially start becoming a semi-variable cost. Say, for example, depreciation. Depreciation up to 200,000 units will be a fixed cost. Beyond 200,000 units, it could become a semi-variable cost. Okay, so this is what was the budgeting and the related discussion. Any this thing? I think yeah, I think it is a separate topic in itself, and we need to really drill it down in greater detail, especially the capital budgeting. I mean, it is actually a separate activity, separate point of discussion where you require about 1 or 2 hours of discussion on that. Any questions on that? Hello?
Nothing
Hello?
No, sir.
from me, Professor.
Hello?
No doubts, Professor.
Okay. And do you want to look at ratios, or you have already studied this?
We have already studied it, Professor.
Okay, so what I will do is that I will anyway send you this presentation. Anyway, it is already being recorded, and but I will send you a copy to Professor Rajan, and then maybe if you need, I think you can also have a look at it, because it is there are a number of slides after this also with regard to the ratio analysis, because I also looked at, I think you must have seen that the Reserve Bank of India recently appointed a committee to look at some of the NPA related issues, and this KV Kamath committee came out with some 4 or 5 ratios to determine the health of some of these companies and how they need to achieve. So in fact, I was planning to cover that, but anyway, that what I will do is that I'll send it through presentation, and then you can have a look at it. Okay. So I think with this, I think we will end the presentation. I had these ratio related slides, but I think maybe we can skip that. Okay. And you can study it, especially the one, I don't know whether you studied this aspect of it. This DuPont system is another form of doing a ratio analysis, which is very, very popular, and which was floated by, I mean, which was, the concept was floated by DuPont, this chemical company. Okay. Okay, thank you everybody. Thank you for joining the call.
Thank you, sir.
Yes, sir.
Thank you.
Thank you, sir.
Thank you.